So if you go and look at the labor market, yes, you're right that the labor market in the US is still really tight. Yes, you're still seeing wage inflation increasing by 5.3%. You are seeing unemployment rate marginally raised from 3.4 in April to 3.7 in May. So yeah, the market is still extremely tight, right? I think you've seen some news in the press that's been announced by organizations throughout the US that are looking at reducing their workforce. And that has been made quite evidently clear through the media. I do feel, though, that they are still, despite that, there's still an increasing purchasing power from the consumer.
So in terms of the rest of the year, what I want to ask you is, obviously, short-term pause. And, as we've seen Jerome Powell from Fed actually talking about it over the past 6 months, he's been saying that, May, June, 525 terminal rate should be sort of the max, or 525 to 550. And then obviously market was actually starting to factor in some, interest rate cuts later in the year. What are your views and what are your thoughts on that? Because, quite heavily here, clients absolutely love trading, gold and US dollar. And we've seen US dollar strength to somewhat over the last few weeks. I would say that's probably purely on the basis that market was, as you mentioned previously, factoring another 25 basis point interest rate rise. However, it's been pulling back over the last few days. So what do you expect in terms of the interest rate cuts by the end of the year? And what's your view on US dollar at the moment?
So look, I think the interest rates and where that's going to look at the end of the year, I think at the current state, I don't see, if you look at the Fed and their priorities, which is around the labor market, around financial stability, and around pricing, right? If I break those down, the financial stability, everyone knows. I don't need to talk too much about that. It's been in the press enough recently. I believe that the Fed is pretty strong and they've made their position clear on the financial stabilities. So assuming that continues, which I don't see any reason why their position should change, you then look at the two other remaining pillars, which are the prices, and you look at the labor market. So if you go and look at the labor market, yes, you're right that the labor market in the US is still really tight. Yes, you're still seeing wage inflation increasing by 5.3%. You are seeing unemployment rate marginally raised from 3.4 in April to 3.7 in May. So yeah, the market is still extremely tight, right? I think you've seen some news in the press that's been announced by organizations throughout the US that are looking at reducing their workforce. And that has been made quite evidently clear through the media. I do feel, though, that they are still, despite that, there's still an increasing purchasing power from the consumer. And this is when it comes back now into the pricing scenarios. So if you've got wage inflation increasing at 5.3, let's assume inflation stays where it is today, which is at 4.9%, what the BLS predicts it at, which I know is a very far reach. It's definitely going to go down. The question is how much, but let's just assume it stays the same. You still have an increasing purchasing power, right? The consumers now, for the first time in a long time, are facing an increasing purchasing power where the wage inflation is greater than inflation. And I think that is a sign where you're looking at retail sales numbers coming out. That has certainly been increasing month on month in terms of percentage rate versus a year ago, still declining. You then have household debt increasing, and they're increasing particularly in two main areas around mortgages and around auto and car loans, so to speak, auto loans. So that feels that there's either people are going heavy on revenge spending and revenge behaviors from being in the situation, an economic environment that's been in the US for the last couple of years. And I think there's another concern here which would counter all this, which is the current economic growth, right? You looked at quarter four, we're at 2.3%. In quarter one, we saw that number drop to 1.3%. Actually, that's the revised one forecast. The initial forecast in April, was 1.1. and they revised it upwards in end of May for the Q1 GDP for growth of 1.3. So it's halved in terms of their growth. So, so basing all that on the tight labor market, I'm assuming that the interest rates will hold at least all the way through to September. And then what we're expecting is that you'll start to see in Q4 marginal reductions in inflation, in the interest rates, and in inflation. But then in the back end of the year, we're seeing already prices increasing, and we're not expecting the war on inflation to be over by the end of this year.
Okay, very interesting view. Thank you so much for that. Very, very valuable for traders and investors out there.